Hi everyone, my name is Chung Yuh and I'm the manager of iFast Fixed Income Division in Singapore. The bond prices of Neptune Orient Lines and its parent CMA CGM have plunged this year. With NOL's SGD notes currently yielding between 22 to 25%, investors might be wondering, is there more upside potential or downside risk? In this video, I will highlight the group's recent operating results, the shipping industry's outlook, and our view on the NOL bond pricings. The past 18 months have been a difficult period for the container shipping sector. Low freight rates in the wake of supply imbalances, higher fuel costs, and geopolitical tensions weigh on shippers' profitability. Against this backdrop, CMA CGM's revenue actually jumped 37% year-on-year to $7.4 billion in the first quarter of 2019, but that was mostly because of its acquisition of the Swiss logistics services provider CEVA Logistics. Excluding this acquisition, the group's revenue grew 5.5%, supported by higher volumes. However, due to higher bunker prices, operating expenses accelerated at a faster pace than revenue, and CMA CGM reported a net loss of $53 million in the first quarter. Despite that, we like that the group has managed to stay cash flow positive despite the losses, with its reported cash flow from operating activities of $715 million in the first quarter. We expect the group's cash flows to stay resilient moving forward, supported by its recently announced $1.5 billion cost-cutting initiative and dividend cuts. On the outlook for shipping industry, significant uncertainties from more stringent regulation to cut sulfur emissions, macroeconomic headwinds, and trade war developments suggest that things will remain difficult for ocean carriers. A new clean fuel regulation effective 2020 will require container ship operators to spend heavily on green solutions. Meanwhile, global trade growth has faltered since the start of 2019 amid slowing economic growth and an escalation in trade disputes. Trade volume is highly correlated to world manufacturing activity, and recent data continues to paint a bleak outlook on manufacturing output. The bonds of NOL and CMA CGM are trading significantly wider than most single B credits, including similarly rated container shippers. We believe the market has already priced in most of the negatives, and it wouldn't take too much of an improvement in CMA CGM's financial profile for bond prices to recover. Some potential positive catalysts include a successful implementation of the group's $1.5 billion cost reduction program, CMA CGM's intention to deleverage, or resolution of the trade war. In short, we think the sell-off in the NOL bonds is overdone, and both the NOL 4.65% 2020 and 4.4% 2021 notes look interesting and are used to maturity of 22% and 25% respectively. With that said, it's important to note that NOL carries a high level of credit risk, and its bonds are suitable only for investors with a high risk tolerance and the ability to diversify their investments widely. If you want to read more about our opinion on NOL and CMA CGM, you can click on the article link listed below.